The last time you filled your tank, you stood at the pump and watched the dollar amount climb past $50, past $60, past $70, and you felt something tighten in your chest that was not pain, but was not nothing either. It was the feeling of watching your money disappear into a machine at a speed that did not exist 2 years ago. And you looked at the price per gallon on the screen and you did a calculation you have never had to do before. You calculated whether you could afford to fill the tank all the way or whether you should stop at $40 and hope it lasts until Friday. Hours ago, Israel and Iran exchanged direct missile strikes for the first time since the April ceasefire. Brent crude surged 4.9% in a single session to $97.67. The CEO of Saudi Aramco, the largest oil company on earth, told investors that even if the Strait of Hormuz opens today, it takes months to normalize, and if it stays closed a few more weeks, the market will not recover until 2027. The U.S. Strategic Petroleum Reserve just posted 2 consecutive record-breaking weekly drawdowns and is approaching levels not seen since 1983. The storage hub in Cushing, Oklahoma, that literally sets the price of your gasoline, has lost 1/3 of its oil in 2 months and is weeks from operational lows. Oil executives went on the record last week using the words really, really low to describe inventory levels. And every diplomatic channel to end this, every single one, Trump's talks, China's mediation, Pakistan's proposal, Oman's monitoring protocol, has stalled or collapsed in the last 72 hours. The price you paid at the pump last time is the cheapest gas you will see for the rest of the summer. That is not a prediction. That is the math of a closed strait, a drained reserve, a depleted storage hub, a gutted refining sector, and a summer driving season that started 5 days ago, pouring 9.5 million barrels of daily demand into a system that is running on fumes. This video is going to show you exactly what happened, exactly what is about to happen, and exactly what you need to do before the number on that sign changes again. Because it is going to change. This week, Israel and Iran just exchanged direct missile strikes for the first time since the April ceasefire, and Brent crude surged 5% in a single session, and nobody on television is telling you what happens next. Hours ago, CNBC reported that Israel and Iran exchanged missile strikes, direct strikes, not through proxies, not through Hezbollah or Hamas or Houthi intermediaries. Israel struck Iran, and Iran struck Israel in the same 24-hour window for the first time since the fragile ceasefire that briefly held in April collapsed. And Brent crude surged 4.9% in a single session to $97.67 per barrel. That is a nearly $5 move in one day on a commodity that underpins the price of everything in your life. And the move happened not because of a shortage, not because of a pipeline explosion, not because of a refinery fire. It happened because the market looked at the missile trajectories and concluded that the one thing that was keeping oil from spiking back above $120, the fading hope that diplomacy might reopen the Strait of Hormuz, just died on a launch pad in the Negev desert. And here is the context that the cable news anchors are not providing because they do not understand commodity markets well enough to explain it. The Strait of Hormuz has been effectively closed or near closed since the U.S. and Israeli military operations against Iran began in late February 2026. That is over 100 days of the most critical oil transit choke point on Earth being functionally shut down. Approximately 21% of the world's daily oil consumption, roughly 20.5 million barrels per day, normally transits the strait, and the IRGC warned early in the conflict that it would set ablaze any vessel attempting transit. That threat was not empty. Iranian forces attacked tankers and infrastructure. Shipping insurance premiums for the region surged to levels that made commercial transit economically non-viable, and the result was the most severe supply disruption since the 1973 OPEC embargo. The International Energy Agency compared the current crisis to both 1970s oil shocks occurring simultaneously, both the 1973 embargo and the 1979 Iranian Revolution combined. That is not a fringe analyst on a blog. That is the IEA, the most authoritative energy body in the developed world, telling you that what is happening right now is worse than anything the oil market has experienced in half a century. And the price history since February tells the story of a market that is swinging between terror and hope and finding no ground to stand on. Brent was at $72 before the war began. It surged past $83 when the U.S. submarine sank an Iranian warship off Sri Lanka, which the defense secretary called the first such attack on an enemy since World War II. It broke $100 when Trump issued a 48-hour ultimatum to Iran. It touched $113.52 when traders realized Iran was not going to comply. It hit $140 on dated benchmarks when the strait was formally blockaded, the highest since 2008. It crashed to $89.80 when reports emerged that Trump was considering seizing the strait militarily to force it open. It climbed back above $118 when the U.S. began besieging Iranian ports and Al Jazeera reported no resolution in sight. It fell to $93 when OPEC Plus announced quota hikes and traders briefly believed the strait might partially reopen through Omani mediation. And today it surged to $97.67 because Israel and Iran exchanged direct strikes and the ceasefire is dead. That price chart is not a market. It is a seismograph recording the tremors of a conflict that has no visible endpoint. And every spike costs you money at the pump. Every spike raises the cost of diesel that moves your food. Every spike feeds into the electricity grid that cools your home. Every spike compounds the inflation that is already eating your paycheck. And the spike that happened today is not the last one. It is the beginning of the next escalation cycle. Because when Israel and Iran exchange direct strikes, the question is no longer whether the strait will reopen. The question is whether it will close harder. The CEO of Saudi Aramco, the largest oil company on earth, told investors on an earnings call that even if the strait opens today, it takes months to normalize, and if it stays closed a few more weeks, the market will not recover until 2027. Amin Nasser is the CEO of Saudi Aramco. Saudi Aramco is the most profitable company on the planet. It produces approximately 9 million barrels of oil per day. Its revenue in 2024 exceeded $400 billion. It controls the largest proven oil reserves of any company in the world. And when Amin Nasser speaks on an earnings call, the energy markets do not just listen, they recalibrate. And on the first quarter earnings call in May, CNBC reported that Nasser said something that should have been front-page news in every country that imports oil, and was instead buried behind political theater and celebrity noise. He said if the Strait of Hormuz opens today, it will still take months for the market to rebalance. Months, not days, not weeks. Months. And then he said if its opening is delayed by a few more weeks, then normalization will last into 2027. The CEO of the company that produces more oil than any other entity on Earth is telling you that the damage from the Hormuz closure is already so severe that even a best-case resolution, the strait opening tomorrow morning, does not bring prices back to normal for months. And a likely case scenario, a delay of a few weeks beyond the current timeline, pushes normalization into next year. And here is why Nasser's timeline matters more than any analyst's forecast. Because Aramco does not model oil markets from a Bloomberg terminal. They model from inside the supply chain. They know how many tankers are sitting idle in the Indian Ocean waiting for the strait to clear. They know how many storage facilities in Ras Tanura and Juaima are at capacity because the oil that was supposed to ship in March and April and May is still sitting in tanks. They know how many downstream refineries in Asia and Europe have been forced to switch to alternative crudes that require different processing configurations, a transition that takes weeks to reverse even after Gulf supply resumes. And they know that the global spare capacity, the buffer of production that can be brought online to compensate for disruptions, has been eroded by years of underinvestment. OPEC Plus just approved its fourth production quota increase since the Hormuz closure, adding 188,000 barrels per day for July. And Jordi Leon, an analyst at Rystad Energy and a former OPEC official, told CNBC yesterday that an OPEC Plus production increase means very little while the Strait of Hormuz remains closed. Because the production is happening, the oil is being pumped, but it cannot get out. The physical bottleneck is not production capacity. It is logistics. It is the tankers that cannot transit the strait. It is the insurance companies that will not cover the voyage. It is the refineries that retooled for non-Gulf crudes and cannot snap back overnight. And the SocGen analysts identified the one thing that has been preventing oil from breaking permanently above $120 right now: China. CNBC reported 2 hours ago that China has reduced its crude imports by almost 3 million barrels per day to the lowest level in 10 years, reflecting reduced refining activity and softer demand. China is the world's largest oil importer, and its pullback has created enough slack in the global market to offset part of the Hormuz squeeze. SocGen called China's demand reduction an enormous rebalancing force, but they warned it will not last, because China is not reducing demand voluntarily. It is reducing demand because its economy is slowing and its refiners are running at reduced capacity. And when the economy stabilizes, the demand returns. And when the demand returns, the cushion disappears. And when the cushion disappears, and the strait is still closed, and Israel and Iran are still exchanging strikes, the price does not go to $100. It goes where it went when the blockade first hit, past $120, past $140. And Nasser told you that even then, the recovery takes months at minimum and potentially stretches into 2027. That is the CEO of Saudi Aramco telling you that the oil market is broken in a way that cannot be fixed quickly. And the gas price you pay at the pump, the diesel that moves your food, the natural gas that powers your electricity, the jet fuel that flies your packages, all of it is priced off a market that the most powerful oil executive in the world just admitted is months or a year away from returning to normal. Nobody on television explained that to you. But Amin Nasser said it on an earnings call. And the earnings call does not lie, because lying to investors is a federal crime. OPEC Plus just approved its fourth production quota increase since the Strait closed, and a former OPEC official told CNBC yesterday that it means absolutely nothing because you cannot export oil through a waterway that is on fire. Yesterday, CNBC reported that OPEC Plus approved another increase in July oil production quotas of 188,000 barrels per day. That is the fourth consecutive quota hike since the Strait of Hormuz closure began. And the headline writers dutifully reported it as OPEC increasing supply. Which technically is true. OPEC is increasing the number of barrels its members are authorized to pump out of the ground. But authorized to pump and able to deliver to a customer are two entirely different things. And Jorge Leon, an analyst at Rystad Energy who spent years as an official inside OPEC itself, told CNBC yesterday the sentence that should have been the headline instead of the quota number. He said an OPEC Plus production increase means very little, while the Strait of Hormuz remains closed. Very little. That is a man who understands the internal mechanics of OPEC better than almost anyone alive, telling you that the production increase your government wants you to believe will lower gas prices is theater. Because here is what OPEC Plus members actually face when they try to export the additional barrels they have been authorized to produce. Saudi Arabia exports approximately 7 million barrels per day. The vast majority of that oil leaves from terminals on the Persian Gulf Coast, primarily Ras Tanura and Juaima. Those terminals load tankers that transit the Strait of Hormuz to reach global markets. When the strait is closed, those tankers do not leave. The oil sits in storage tanks that are already approaching capacity. Saudi Arabia has a limited pipeline that connects its eastern oil fields to the Red Sea port of Yanbu on its western coast. That pipeline, the East-West pipeline, has a maximum capacity of approximately 5 million barrels per day, but typically operates at 2 to 3 million. It was designed as a strategic bypass for exactly this scenario, but it cannot carry the full export volume, and the UAE, Kuwait, Qatar, and Iraq face similar constraints. Their export infrastructure was built around the strait. They do not have bypass pipelines to alternative coasts. Their oil is functionally landlocked until the strait reopens. And the Discovery Alert analysis from yesterday laid out the structural blind spot that cartel theory was never designed to account for. They wrote that the Iran conflict has exposed the difference between the authority to produce and the physical ability to export. That is the sentence that explains why every OPEC Plus quota increase since the strait closed has failed to move prices downward in any sustained way. The oil is being produced. It is sitting in tanks. It cannot reach the refineries in Asia, Europe, and the Americas that need it. And the refineries that cannot access Gulf crude have been forced to source alternatives from West Africa, Brazil, the North Sea, and the United States. Those alternatives are more expensive because they are in higher demand. They require different processing configurations because their API gravity and sulfur content differ from Gulf benchmarks, and the transition is not instantaneous. Refineries that retooled for lighter, sweeter crudes cannot snap back to heavier Gulf grades the day the strait opens. Nasser already told you that takes months. And in the meantime, every OPEC Plus quota increase is a number on a spreadsheet that does not correspond to a barrel of oil arriving at a refinery that can process it into the gasoline you put in your car. The quota is a press release. The strait is the reality. And the reality is that the most important oil transit choke point on Earth is closed. The military conflict that closed it just escalated with direct missile strikes between Israel and Iran, and the production that is supposed to replace the lost supply cannot physically get to the market. OPEC Plus is not solving the problem. OPEC Plus is performing the appearance of solving the problem while the actual problem sits in the geography of the Persian Gulf and the physics of a waterway that is on fire. The United States just drained its emergency oil reserve at the fastest rate in history, and the stockpile that was built after the 1973 Arab oil embargo to protect you from exactly this scenario is approaching levels not seen since 1983 when it was still being filled for the first time. Bloomberg's Javier Blas reported 3 weeks ago that U.S. total crude inventories fell approximately 17.8 million barrels in a single week. That is the largest weekly decline since the data series began in 1982, the largest in 44 years of records. And Bloomberg's Joe Weisenthal confirmed that the Strategic Petroleum Reserve posted its largest one-week drawdown in history, both on an absolute basis and on a percentage basis, in the week ending May 20th. 9.92 million barrels drained in 7 days. That came on top of 8.6 million barrels the previous week. 2 consecutive record-breaking weeks, back-to-back. And the SPAR, which stood at 726.6 million barrels at its all-time high in December 2009, has been cut to 365.1 million barrels as of the week ending May 22nd. That is roughly half, and Newsweek reported 6 days ago that at the current drawdown pace, GasBuddy analyst Patrick DeHaan predicts the reserve is days away from reaching levels last touched in August 1983, when the reserve was still in its initial fill-up stage. Let me say that differently. The emergency oil stockpile that Congress authorized after the 1973 OPEC embargo to protect the American economy from exactly the kind of supply shock that is happening right now is about to drop below the level it was at when it was being filled for the first time 43 years ago. The reserve has been drained by approximately 58 million barrels since the Iran war began on February 28th. And CNN reported 1 week ago that Trump is draining the SPR at a faster pace than Biden did during the 2022 energy crisis, despite having spent years criticizing Biden for recklessly depleting it. Trump told supporters at his 2024 campaign launch that the strategic reserves, which I filled up, have been virtually drained in order to keep gasoline prices lower just prior to the election. And now his administration is doing the same thing, at a faster rate ahead of the 2026 midterms, while a war that his administration started is the cause of the drain. And the Department of Energy is not simply selling the oil. They are releasing approximately 172 million barrels through an exchange program that requires the buyers to repay the oil between 2026 and 2029, with an 18 to 24% premium in kind. That means the government is lending oil today and expecting more oil back later, which only works if the oil market normalizes enough for the buyers to acquire the replacement barrels at a reasonable price. If prices stay elevated through 2027, which Aramco's CEO just said is a plausible scenario, the repayment becomes more expensive, and the buyers may default or renegotiate. And the reserve that was supposed to be refilled ends up emptier than it started. And 24/7's Wall Street reported 4 days ago that consumer sentiment hit an all-time record low of 44.8 in May 2026. All-time, lower than during the 2008 financial crisis, lower than during COVID, lower than at any point in the survey's history. The American consumer knows that the reserve is being drained, they know the prices are not coming down, and they know that the cushion that was supposed to protect them is disappearing faster than anyone predicted. The SPR was created to be a buffer between you and an oil shock. The buffer is almost gone, and the shock is still happening. And the next disruption, the next escalation, the next missile strike, the next tanker attack, lands directly on your gas price with no government cushion to absorb it. That is where you are right now. Standing at the pump with no emergency reserve between you and whatever the market does next. Oil executives went on the record last week warning that physical inventories are approaching levels they described as really, really low, and the storage hub that prices your gasoline lost a third of its oil in 2 months. Fortune published a headline 1 week ago that should have caused a national conversation and instead was buried under the usual cycle of political noise and celebrity gossip. The headline said oil bosses warn prices will soar in a matter of weeks as inventories near unprecedented lows. And inside the article was a quote from an unnamed senior executive at a major oil company who described the current inventory situation with a phrase that is not typically found in corporate communications. He said, really, really low levels. That is an oil executive, a person whose job requires measured, precise, legally scrutinized language, using the words really, really low to describe the physical oil inventory situation in the United States. And the data supports every syllable. Koppler, one of the most respected commodity data firms in the world, provided Fortune with the numbers from Cushing, Oklahoma. And if you do not know what Cushing is, you need to know right now because your gasoline price is literally determined there. Cushing is the delivery point for West Texas Intermediate crude oil futures. It is the physical hub where the price of American oil is set. When traders on the New York Mercantile Exchange buy and sell WTI contracts, the settlement requires physical delivery of oil at Cushing. The tanks at Cushing are the backbone of American oil pricing. And Kapler's data shows that inventories at Cushing have fallen from 33 million barrels approximately 2 months ago to about 24.5 million barrels today. That is a loss of 8.5 million barrels, more than 25% of the total in roughly 60 days. And the operational minimum for Cushing is approximately 20 million barrels. Below that level, the tanks cannot physically deliver oil efficiently because the pumps lose suction, and the pipeline connections require minimum levels to function. That means there are approximately 4.5 million barrels of usable inventory standing between the current level and the point at which the pricing hub for American crude oil becomes operationally impaired. At the current drawdown rate, that threshold is weeks away, not months, weeks. And when Cushing hits its operational floor, something happens that most Americans have never seen. The futures market that is supposed to discover the fair price of oil stops functioning normally. The spread between the front-month futures contract and the next month widens dramatically because traders holding contracts that require physical delivery at Cushing cannot find the oil to deliver. This condition is called super backwardation, and it is the market's version of a fire alarm. It signals that the physical supply of oil in the most important storage hub in the country is no longer sufficient to support normal market operations, and super backwardation does not lower prices. It spikes them, because every refiner, every airline, every trucking company, every municipality that buys heating oil, every industrial consumer that needs crude begins panic buying whatever is available because the alternative is running out. And when buyers panic and supply is physically constrained, the price does not move incrementally. It gaps. It jumps $5 or $10 or $15 in a single session. And that jump lands on your gasoline price within 48 to 72 hours, because the gas station prices at the pump are priced off the wholesale market, which is priced off the futures market, which is priced off the physical oil at Cushing. The pipeline from Cushing to your wallet is direct and fast. And right now, that pipeline is running through a hub that has lost a third of its oil in 2 months and is weeks away from levels that an oil executive described with a term that should terrify every person who drives a car, heats a home, or eats food that was delivered by a truck. Really, really low. That is not a forecast. That is a measurement of something that is happening right now in the physical world. In tanks you have never seen, in a town you have never visited. That determines the price of your life. Summer driving season started 5 days ago, and Americans are about to add 9.5 million barrels of daily gasoline demand into a market that is already running on fumes, and nobody has told you what that collision looks like. Memorial Day weekend marked the unofficial start of summer driving season. It began 5 days ago. And for the next 100 days, through Labor Day in September, Americans will drive more miles, burn more gasoline, take more road trips, and consume more fuel than at any other period of the year. The EIA estimates that U.S. gasoline consumption during summer driving season averages approximately 9.3 to 9.5 million barrels per day, compared to roughly 8.5 to 8.8 million barrels per day during the winter months. That is an incremental demand increase of roughly 500,000 to 700,000 barrels per day, layered on top of a market that is already experiencing the most severe supply disruption in half a century. And GasBuddy, the most widely used fuel price tracking platform in the country, released its summer forecast weeks ago, projecting a national average of $4.48 per gallon on Memorial Day weekend, and a summer peak of $4.80 per gallon. That forecast was published before Israel and Iran exchanged direct strikes this week, before the ceasefire collapsed, before Brent surged 4.9% in a single session. That $4.80 forecast is already outdated, and the revised number, if GasBuddy updates it this week, will be higher. How much higher depends on whether the Strait stays closed, whether the SPR drawdowns continue at record pace, whether Cushing hits its operational floor, and whether the next escalation in the Iran conflict sends Brent back above $120 where it was in April. And here is the seasonal dynamic that makes this summer different from any summer in recent memory. In a normal year, the summer demand surge is absorbed by refinery throughput increases. Refineries ramp up gasoline production in the spring, build inventory ahead of the driving season, and run at 90 to 95% utilization through the summer to meet peak demand. That preparation assumes stable crude supply, reasonable input costs, and a functioning global logistics network. None of those assumptions hold in 2026. The crude supply is disrupted by the Hormuz closure. The input costs are elevated by war premiums, sanctions, and the Strait bypass adding weeks of transit time for alternative crudes. And the logistics network is strained by tanker diversions around the Cape of Good Hope, which adds 10 to 14 days to every delivery from the Gulf to Europe and Asia. Refineries are not running at 90 to 95% utilization. They are running at 85 to 88% because the crude grades they need are either unavailable or priced at premiums that compress their margins. And the gasoline inventory that was supposed to be built in the spring was not built because the crude to produce it was sitting in tanks on the wrong side of a closed waterway. CNBC's national average on Memorial Day weekend was $4.55 per gallon, already above GasBuddy's forecast. And in California, where the gas tax is higher, where the refining capacity has been cut by 30%, and where the state is now importing gasoline from China through S&P Global documented arrangements, the average was $6.13, and diesel, which moves everything else, was $6.30 in Chicago and approaching $8 in San Francisco. And every cent increase in diesel flows directly into the price of food, medicine, consumer goods, and every other product that arrives at your store on a truck. Summer driving season is not a suggestion. It is a physical reality driven by school vacations, family travel, and the American relationship with the automobile. You cannot tell 200 million drivers to stay home because the oil market is disrupted. They will drive, they will consume, and the gasoline they consume will be drawn from a supply that is already at its thinnest level in decades. The collision between peak demand and constrained supply does not produce a gentle price increase. It produces a spike, and the spike is coming this month. Not in theory. In the math of 9.5 million barrels per day of demand, meeting a supply system that the CEO of Saudi Aramco says will take months to normalize even if the strait opens tomorrow. The United States has lost more refining capacity in the last 5 years than at any point since World War II, and the bottleneck between the crude oil in the ground and the gasoline in your tank is now tighter than the Strait of Hormuz itself. Crude oil does not go into your car. Gasoline does. And the transformation from crude oil into gasoline happens in a refinery. And America has been closing refineries at a rate that should have triggered a national conversation years ago, but did not because the closures happened quietly, one facility at a time in communities that nobody on cable news was paying attention to. S&P Global confirmed that California has lost approximately 30% of its refining capacity in the last 5 years. Phillips 66 closed its 139,000 barrel per day Los Angeles refinery in 2025. Valero closed its 170,000 barrel per day Benicia facility. Marathon Petroleum shuttered operations at a California facility earlier. And 3 companies now control roughly 90% of the remaining refining capacity in California, which means the state that is home to 39 million people and consumes more gasoline than most countries is now dependent on a refining oligopoly that has every incentive to keep supply tight and margins wide. And the closures are not limited to California. Across the United States, approximately 1.3 million barrels per day of refining capacity has been permanently shut down since 2019. Philadelphia Energy Solutions, the largest refinery on the East Coast, exploded and closed in 2019. Multiple smaller refineries across the Gulf Coast, Midwest, and West Coast have been converted to renewable diesel facilities or shut down entirely, and no major new refinery has been built in the United States since 1977. That is 49 years, nearly half a century without a new refinery. The existing facilities are aging. They require constant maintenance, and every maintenance turnaround, which typically occurs in the spring and fall, takes a facility offline for weeks and reduces total available throughput during the exact periods when inventory should be building ahead of peak demand seasons. And a USC and UC Berkeley analysis described California's situation as being on the brink of a cascading fuel supply failure. That phrase, cascading fuel supply failure, is the kind of language that engineers use when they are describing a system where one failure triggers the next, and the dominoes fall faster than anyone can intervene. And Calm Matters reported that the state's fuel supply is stable for 6 weeks but uncertain after that. 6 weeks from the time of that report puts the uncertainty window squarely in the middle of July, peak summer, peak demand, and the state is importing gasoline from China because it cannot refine enough of its own. An American state importing finished gasoline from China in 2026 because it closed its own refineries, and here is the refining bottleneck in one sentence. Even if the Strait of Hormuz opened tomorrow and crude oil flooded back onto the global market and Brent dropped to $70 a barrel, the price at the pump would not drop proportionally because the refining capacity that converts that crude into gasoline is not there anymore. It was closed. It was demolished. It was converted. And it is not coming back because no investor in their right mind is going to spend $10 to $15 billion and 7 to 10 years building a new refinery in a country whose stated policy trajectory is to phase out internal combustion engines. The refinery closures were a one-way door, And America walked through it without anyone telling you that the other side has less gasoline, higher margins for the refiners who remain, and no way to reverse the decision when the crisis arrives. The crisis has arrived, and the bottleneck between the crude in the ground and the gasoline in your tank is now tighter than the strait itself, because the strait will eventually reopen. The refineries will not. Goldman Sachs estimated that $14 of every barrel of oil you are paying for right now is pure war premium. And if the conflict escalates this week, that premium doubles and oil goes to a number that has historically triggered a recession every single time it has been reached. Goldman Sachs, the most influential investment bank in the global energy market, estimated that approximately $14 per barrel of the current Brent crude price is war premium, pure risk pricing, not based on supply and demand fundamentals, based on fear. Fear that the strait stays closed, fear that the conflict widens, fear that a tanker gets hit, fear that a refinery gets struck, fear that the next headline is worse than the last one. And at $97.67 per barrel, which is where Brent closed after today's surge, that means the fundamental value of Brent without the war premium is approximately $83 to $84, which is still elevated but manageable. The problem is that war premiums do not stay constant. They are not a fixed surcharge that gets added once and stays. They are a function of perceived risk, and perceived risk is a function of events. And the events of this week, direct missile strikes between Israel and Iran, for the first time since the April ceasefire, Trump rejecting Iran's counteroffer, Hezbollah rejecting the U.S.-brokered ceasefire, and an explosion at the Mina al-Fahal export terminal in Oman are the exact kind of events that cause war premiums to double. If the $14 premium doubles to $28, Brent goes from $97 to $111 to $125, depending on the baseline. And Goldman revised its 2026 Brent forecast upward to $85 from $77, but that revision was made before this week's escalation. The actual trading range has been $30 to $50 above Goldman's forecast for months. And here is why $120 to $140 oil matters for your life in a way that $90 oil does not. Every major recession in the last 50 years has been preceded by a significant oil price spike. The 1973 OPEC embargo quadrupled oil prices and triggered a recession that lasted 16 months with unemployment hitting 9%. The 1979 Iranian Revolution doubled oil prices and triggered a recession that lasted 6 months, followed by a second recession in 1981 that pushed unemployment to 10.8%, the highest since the Great Depression. The 1990 Iraqi invasion of Kuwait spiked oil prices 60% and contributed to the 1990-91 recession. The 2008 oil price surge to $147 per barrel preceded the financial crisis, which was the worst economic downturn since the 1930s. The pattern is not ambiguous. It is not debated by serious economists. When oil spikes above a certain threshold relative to the economy's capacity to absorb it, consumer spending contracts, business costs surge, margins compress, layoffs begin, and the economy tips into recession. And the threshold in 2026 is lower than it was in 2008 because the consumer is weaker. Credit card debt is $1.252 trillion at 23.79% APR. The savings rate is 4%. Consumer sentiment is at an all-time record low of 44.8. 45% of households cannot make ends meet. The economy is already being held up by the spending of the top 10% and the investment of 5 AI companies. Remove the war premium cushion that China's demand reduction is currently providing, which SocGen warned will not last, and the oil price spike that hits the American consumer lands on a population that has no buffer to absorb it. No savings, no credit capacity, no SPR to dampen the shock. And the recession that every oil spike in the last 50 years has triggered does not arrive as an announcement on television. It arrives as a layoff email in your inbox, as a for sale sign on your neighbor's lawn, as a credit card that gets declined at the grocery store, as a school that loses its bus funding, as a fire department that rations diesel, and as a gas price on the sign outside your local station that makes you sit in your car and do the math and realize that the number is bigger than your paycheck. That is what $140 oil looks like in a consumer economy that is already running on fumes. And the distance between here and $140 is one bad week in the Middle East. And this week is already bad. Every single diplomatic path to reopening the strait has collapsed in the last 72 hours, and the 3 men who could end this crisis, Trump, Xi, and Khamenei, are all moving in the wrong direction for your gas price. CNBC reported that Trump rejected Iran's counteroffer to the U.S. proposal to end the conflict. Rejected it. Iran put a deal on the table, and the United States said no. And then CNBC's geopolitical risk analyst Henry Wilkinson said Trump may ask Xi Jinping to press Iran to accept U.S. terms later this week, during talks between China and the U.S. That sentence contains the entire structure of the diplomatic trap, and once you see it, you will understand why the Strait is not reopening anytime soon. The U.S. is fighting a war against Iran. Iran's closest economic partner is China. China is the world's largest oil importer, and the one country whose demand reduction is currently preventing oil from breaking above $120. And the U.S. is asking China to pressure its own oil supplier to accept terms that benefit the U.S. Think about that for a moment. China has zero incentive to help the United States end this war on American terms. A prolonged conflict keeps the U.S. spending $1 billion a day, erodes American credibility in the Middle East, accelerates de-dollarization, as countries seek alternatives to a currency weaponized through sanctions, and gives China leverage in every bilateral negotiation it conducts with the U.S. on trade, Taiwan, and technology. China is not going to rescue America from a war America started. China is going to let the war drain American resources, while quietly building the alternative global architecture that BRICS has been constructing for years. And Khamenei is not going to accept terms that require Iran to surrender its nuclear program, which is what the U.S. Phase 2 demands. Secretary Rubio told the Senate Foreign Relations Committee that Phase 1 addresses Hormuz only, and that nuclear issues and sanctions wait for Phase 2. But Iran views the nuclear program as its only insurance policy against regime change. Surrendering it is existential. They will not do it. Which means, even if Phase 1 succeeds and the Strait partially reopens, Phase 2 will stall, and the underlying conflict will continue, and the war premium will remain embedded in oil prices because the market knows that a partial reopening under fragile diplomatic terms can collapse at any moment. And Pakistan is mediating a separate proposal that sequences Hormuz reopening before nuclear talks. But the U.S. has stated a preference for nuclear talks first. The two sides are not just disagreeing on terms. They are disagreeing on the order in which the terms are discussed. That is not a gap that gets bridged in a week. That is a structural impasse. And while the diplomacy stalls, the battlefield is escalating. Israel and Iran exchanged direct strikes hours ago. Hezbollah rejected the U.S.-brokered ceasefire in Lebanon. An explosion hit the Mina al-Fahal export terminal in Oman, which briefly disrupted operations at a facility that is not in the Strait but is in the broader Gulf logistics corridor, reminding every trader that the disruption risk extends beyond the Strait itself. And the Discovery Alert analysis published yesterday outlined two scenarios for the remainder of 2026. Scenario A is a partial Hormuz reopening through naval escort arrangements, with Brent stabilizing at $65 to $75. Scenario B is a prolonged blockade extending through the third quarter with OPEC Plus members breaking from the quota framework entirely. Scenario A requires a diplomatic breakthrough that every signal from this week says is not coming. Scenario B requires nothing. It is the default. It is what happens when diplomacy fails and the conflict continues, and the Strait stays closed and the SPR keeps draining, and Cushing keeps declining, and summer demand keeps surging. The default outcome is higher oil, and the three men who could change the default, Trump, Xi, and Khamenei, are all pursuing strategies that make the default more likely, not less. Trump wants unconditional surrender on the nuclear issue. Xi wants the war to continue weakening America. Khamenei wants to survive. None of those objectives produce a reopened Strait. And your gas price is set by the Strait. The price you see on the gas station sign today is the cheapest gas you will see for the rest of the summer, and every day you wait to prepare is a day closer to the moment when the number on that sign makes you choose between driving to work and feeding your family. I have spent this entire video showing you what is happening to oil right now. Not what might happen, not what could happen in some theoretical worst case. What is happening? Israel and Iran exchanged direct missile strikes hours ago. The ceasefire is dead. Brent surged 4.9% in a single session to $97.67. Saudi Aramco's CEO told investors that even if the Strait opens today, normalization takes months, and if delayed a few more weeks, it extends into 2027. OPEC Plus's fourth quota increase was dismissed by a former OPEC official as meaning very little, while Hormuz remains closed. The SPR posted 2 consecutive record-breaking weekly drawdowns and is approaching levels not seen since 1983 when it was still being filled for the first time. Cushing, the pricing hub for American crude, has lost a third of its inventory in 2 months and is weeks from operational lows. Summer driving season started 5 days ago, adding 700,000 barrels per day of demand into a market that cannot absorb it. The U.S. has lost 1.3 million barrels per day of refining capacity since 2019, and California is importing gasoline from China. Goldman Sachs identified $14 per barrel of war premium that is poised to double if the conflict escalates further this week. Every single diplomatic channel, the U.S.-Iran talks, the China mediation, the Pakistani proposal, the Omani monitoring protocol, has stalled or collapsed in the last 72 hours. And the oil executives who have visibility into the physical inventories are using the words really, really low in public for the first time. And consumer sentiment is at its all-time record low of 44.8. That is where you are standing right now. And the gas price you see on the sign outside your local station today, right now at this moment, is the cheapest gas you will see for the rest of the summer. I need you to understand that. Every day that passes, every headline that escalates, every barrel that drains from the SPR and from Cushing, every tanker that cannot transit the strait pushes the price higher. The $4.55 national average on Memorial Day was higher than GasBuddy's forecast. The $4.80 summer peak forecast is already outdated, and the trajectory, unless a diplomatic miracle occurs this week, points toward $5.50 to $6 nationally and $7 to $8 or higher in California, the Pacific Northwest, and the Northeast. So here is what I am asking you to do. Fill your tank today. If it is not full, fill it tonight. Every gallon you buy today is a gallon you will not buy at a higher price next week. If you have a second vehicle, fill that too. If you have gas cans, fill them safely and store them properly. The gallon that costs $4.55 today may cost $5.50 in 3 weeks and $6.50 in 6 weeks. Reduce every non-essential drive starting now. Consolidate your errands into one trip. Carpool to work if you can. Walk or bike anything under 2 miles. Every gallon you save is a gallon you have when the price doubles and the person next to you has nothing. If you have a long commute, talk to your employer this week about remote work options. Not because it is convenient, because at $6 or $7 gas, the cost of commuting may exceed the net benefit of the job for lower-wage workers. And that is a calculation that millions of Americans are about to face. Build your food buffer now. Not because the food supply is going to disappear, but because every link in the food supply chain runs on diesel, and diesel follows crude, and crude is on a trajectory that oil executives are calling unprecedented. The food you buy this week at current prices is cheaper than the food you will buy in August at prices that reflect $120 oil and $7 diesel. Stock your pantry. Buy the rice, buy the beans, buy the canned goods. Every dollar you spend on shelf-stable food today is a dollar that buys more calories than it will in 90 days. And know your neighbors. I say it in every video. The person next door who has a generator. The coworker who can carpool. The friend who has a garden. Those connections are the infrastructure that does not depend on the Strait of Hormuz, the SPR, or the price of Brent crude. Nobody is ready for what is about to happen to oil, but you can be. And the difference between the family that prepared and the family that did not is the difference between a difficult summer and a devastating one. Fill your tank, stock your pantry, reduce your driving, and pay attention to what happens in the Middle East this week. Because whatever happens there lands on your gas price within 48 hours.